April webinar. Today, our guest presenter, Bob Fouratt of the Curchin Group, will discuss the Supervisory Committee's role in effective oversight of risk management. Please be aware that this webinar is being recorded. All participants' lines are being muted to reduce background noise. If you would like to submit a question during the webinar, please use the question dialog box to type in your question and submit the question to our presenter. If we have time at the end of the session, we will be asking or answering those questions for you. Again, if you have a question, please type it into the dialog box and submit it. And if there is time at the end of the webinar, we will be addressing those questions. With that, I'd like to turn this over to our webinar presenter, Bob?
Yes, ready to go. Okay, so my screen should be up at this point. Okay, and we're ready to go. Okay, Celeste had contacted me back in the winter and was asking for some topics that we might use for some webinars. And I was stopped and thought for a few minutes about this particular topic, because we've seen from NCUA just a renewed focus on risk management. As we've come through some really difficult times in the industry, NCUA has become very concerned with excessive risk-taking, and they're kind of beginning to push, and we're seeing you know, almost a new business model they want to see adopted in credit unions that reflect sounder risk management principles and an increase in transparency of the risk that you may be engaging in. So we as, oops, okay, hang on a second, PowerPoint doesn't seem to want to work here. There we go. So, you know, why don't we just start off with a very simple question? You know, what is risk management? You know, risk management, and that phrase started to come into vogue in the 1990s, and there's, you know, a lot of theory and behind, you know, risk management, and it can get very complex or it might be very basic. But I just boiled down risk management to these four following concepts. You know, one, you avoid risk by choosing not to undertake certain types of activities. You know, perhaps it's business lending of some sort, or lending in a particular industry, or whatever those things might be. The second is yes.
I'm sorry to interrupt. I don't know that we are able to see your screen at this point. If we can just take a moment and have you bring that up. I apologize for interrupting.
That's okay. What's, hold on a moment. Let's. Okay.
You want to, go down to your PowerPoint there and click that. That should do it. That should bring it up.
Are we seeing it now?
Not at this point, no.
Okay, hang on just a moment.
The joys of technology.
Yep. Okay, I have. Let me just close this for a minute, or let me reset up this slideshow.
Yeah, and just so that all of our participants know, we will make these handouts available after the webinar. So.
Okay. All right, we have that. Let's. Okay. Is it up now?
It's up.
Okay. So let me back up a little bit and launch into this again. As I said, you know, risk management and the concepts of risk management came into vogue in 1990. And, you know, they can be very complex. They can be, you know, very basic. So, you know, we'll just start with this question of what is risk management. And, you know, as I said, I boil it down to four basic concepts. One, we avoid certain risks. You know, we won't lend in certain areas. We won't be in certain industries. We mitigate risk through setting up preventative and detective controls and processes, good internal controls, good operating processes. The third thing we do is we transfer risk to outside third parties. We have insurance, perhaps. We outsource certain services like home banking or mobile banking. We end up outsourcing through a third party. Or lastly, we can just basically accept the risk that because we figure out that the benefits outweigh the costs of trying to mitigate or transfer the risk to another party. Enterprise risk management became the hot topic probably in the last 5-6 years. And all enterprise risk management is a coordinated, integrated approach to managing your risk. It's every part of the organization becomes responsible for managing risk, and you actively put into place certain processes and guidance that is provided by a centralized risk management coordinator. Now, this sometimes they have, you know, person. This is in a larger institution. This might be their title, the risk management coordinator. It might be your COO. It could be your CEO, just depending upon the size of those items. You know, the size of your institution. If you've been to some NACUSAC seminars before on risk management, you'll be familiar with this cube. But what the cube does is kind of illustrate how all of our, the enterprise, how it gets cross-managed. What we want to do is break down the silos and make sure that the objective setting and event identification is going on throughout the organization. You know, whether it's at the top level, at a division level, a subsidiary level, that all these activities are going on that affect our strategic planning, our operations, our reporting, and compliance. And the other advantage of enterprise risk management is that hopefully, if done right and done well, it improves the effectiveness in the allocation of your resources, because we only have so many people, so many dollars, and we decide then how we're going to distribute those throughout the organization. You know, there's some general risks faced by all credit unions. First of all, there's credit risk, interest rate risk, transaction risk, compliance risk, strategic risk, and reputation risk. We're all quite, you know, familiar with credit risk and interest rate risk. This is, you know, credit risk is the risk someone can't pay their loan or someone defaults on an investment that you take out. Interest rate risk has to do with your exposure to the institution in, you know, in changing interest rate environments. Transaction risk has to do with the posting of transactions and whether or not they're done correctly. Or compliance risk, again, you know, are we in compliance? Strategic risk, you know, what is our plan? What are our strengths? What are our weaknesses? What, you know, what are obstacles to carrying out our strategic plans? And last, obviously, is reputation risk. And no credit union that I'm aware of likes to find themselves in the newspaper or anything else, but, you know, obviously it's an important risk to consider along the way. Typically, the board has responsibilities for approving the overall direction of the credit union. And they're involved in and should be involved in the planning processes so that they can clearly understand the current business strategies, critical success factors, and any related risks. They also are responsible for overseeing the processes and controls that management has put in place to identify and manage risk. And they should be actively reviewing the impact of these risks on the achievement of the credit union. And they set and determine the nature and extent of risks that are acceptable for the credit union to bear. So not management, but that's a primary board responsibility, that they set the overall tolerances for how much risk you wish to bear. Typically, the thought that comes to mind that board members approve your ALM policy, which has tolerances and how much interest rate risk you're willing to take. That's a conscious decision by the board as to how much interest rate risk you're willing to take. So if it's the board's responsibility, how do we as supervisory committee members really get involved with this? Well, if we go to the regulations, NCUA rules and regulations 715, we look at those, one, we're to determine that the board of directors and management have established practices sufficient to safeguard the members' assets. So it's a safety and soundness issue that we're looking at. And in 7153B, that you're to ensure that their plans, their business plans, their policies, the controls that they have in place are properly administered along the way, and that, as again, these policies and procedures are sufficient to safeguard against error, conflict, self-dealing, or fraud. So we have, as supervisory committee members, this high-level responsibility to make sure that the board is conducting itself in a safe and sound manner. What are these critical areas responsibility that come to us? First is we have to understand the credit union's risk philosophy. And everybody's an appetite for risk, I guess would be the best way to put it. Everybody's appetite for risk is different, but that's with each institution, we need to determine what that risk appetite is going to be. Secondly, we should, as committee members, have an understanding to the extent management has established enterprise risk management within our organizations. And periodically then would be to review the credit union's portfolio of risk and consider it against the appetite for risk. So if the board has established that certain tolerances are to be met in your exposure to interest rates and you've exceeded those tolerances, you should be asking, why aren't, what are we going to do to bring ourselves back in accordance with those tolerances, and how did we get there in the first place, and what steps are we taking to make sure that we return to within the tolerance levels approved by the board. So why don't we talk about understanding risk philosophy and that risk for appetite. I think the first part in determining everyone's risk philosophy is to take a look at the tone at the top, and what are the values that the credit union has, and does the credit union promote a risk-aware culture? Couple of things that you can do is at these planning sessions, I don't know how many of you are invited to your strategic planning sessions, but most of my supervisory committee members do attend. They need to take an active role in those discussions that are going on in those planning sessions. You need to ask those tough questions. Sometimes management gets, a little possessive of something, but you need to ask the tough questions. You need to challenge the assumptions that management is providing in discussions of strategy and that risk. And at all times, you have to focus on the interest of the key stakeholders, which are indeed a little bit different from other institutions. Those are our members, not necessarily management, not outside shareholders or anything in those roles. Tone at the top. We need to look at this because, well-run institutions and poorly run institutions, we go in, there's typically, a distinctive tone at the top. What is management's attitude? What is the board's attitude? And so we need to look at certain things. The actions of the board and the actions of management need to be compatible and with the credit union's values and stated objectives. Things that we kind of look at when we're looking and evaluating that tone at the top is, number one, the choice of the CEO. This is the individual who's charged with the day-to-day operations and carrying out the strategic plan. Secondly, we look at the selection of directors. The individuals coming onto the board, do they have the appropriate background? Do they have the appropriate experience to be helping us set a strategic plan and driving us forward on this strategic plan? Obviously, then we need to look at the strategic plan. Does it make sense? Is it doable? Is it the plan in line with our values, what we see our role is to our members, and how we offer value to our members? Code of conduct, we all probably have these in place, but do we have a good, strong code of conduct that's enforced fairly and evenly throughout the organization? The other item here, which sometimes gets management a little bit upset, but how is, and you should be aware of, how is the executive compensated? Is his compensation package put together in such a way that it encourages excessive risk-taking? So in other words, that we are taking, he's getting significant bonuses for accomplishing very short-term goals or very aggressive short-term goals versus the long-term strategic direction of the credit union. And lastly, since many of us do attend the board meetings, but we are all entitled to get the minutes, is, we need to look and make sure that risk management is being discussed at regular board meetings, that, we just don't have a long list of consent agenda items and say, okay, but on regular basis, the board should be talking about risk management, whether it's, a particular area, what it has to do with the, strategic plan, all those items. Risk philosophy. The question here, question 2, is, is our risk management integrated with the credit union strategic direction? Obviously, we want to develop a strategic direction, and approval of that understands that direction, selection of that direction requires a thorough understanding of risks that might affect carrying out that plan. And the planning process, it has to take into all sorts of areas of the credit union. Our human resources, what are our competencies, our strengths, our weaknesses, what are the threats, what is our competition, what are they doing in the marketplace, involved in pulling together this entire plan. We should determine that management has set up some key performance targets, and there's active consideration of those, and these performance targets are based on the trade-off between risk and reward. And lastly, and I do participate in some of my clients' annual strategic planning sessions, is when a strategic plan and operating plan is being presented, it shouldn't just be on the best case scenario or even the most likely scenario. My best run credit unions will present 3 scenarios. Best case, what we likely think will happen, and then the worst case. What happens if this just all blows up in our face and goes down the tube? So you need to look at what those are so that you can be prepared to react to that worst case scenario if some things don't go the way we plan them to go. The third question is, how do we, the credit union, what our expectations for risk are, how are they going to be communicated and followed by the employees of the credit union? They may not, come to our strategic planning sessions. They may not get to hear these open and frank conversations regarding risk, regarding strategic, our strategic programs and those types of things. So the question is, do we have a program to communicate and train our employees when it comes so that they're aware of risk and promoting a risk-aware culture? We need to provide them with excellent policies and procedures, and we need to make sure that there are a system to monitor risk awareness in place. Internal audit is typically an important factor in this monitoring process, but there are risk assessment, self-assessment workshops out there. There are employee surveys that can be used to help monitor the employee's attitude towards risk and the management of risk. Oh, I'm sorry. So, Bob, you got a lot here on our plate, and what the heck are we going to do this? We already have to worry about, monitoring, accounting controls and compliance controls, and we have internal auditors to deal with and external auditors to deal with. What are we going to do? I think, this question you get to ask yourself, what are our priorities? It takes some time to define what your committee's role is going to be in risk management. And again, sometimes when we've seen our committees start to do this, they bump heads a little bit with management and the board. But remember, you have that, that high-level responsibility to make sure that policies and procedures are in place so that the credit union is operated in a safe and sound manner. What do you do to, make use of your limited time? Well, I think you take into consideration different things. The size and nature of your credit union. Certainly, Navy Federal is large and very complex, as opposed to, a $20 million credit union, here in the state of New Jersey. What's your level of trust and confidence in the CEO? Is the CEO always been a very high performer? Is he, just kind of a babysitter? Those kind of enter into it because it's going to be the CEO who makes sure that these things do happen. Third consideration is the rate of change in our industry and the outside world, and we are going through, a tremendous amount of change in our industry. We're continuing to see a significant amount of consolidation. Technology is pushing us to have new delivery systems, new products in place. And yet we still have to maintain and manage our old delivery systems. They haven't gone by the wayside at this point. And, we need to look at how effective our structures and processes are in place. If you have a good, effective structure, then you're not going to be spending a significant amount of time looking at this, and you're just going to be in an oversight mode to make sure that these things are indeed occurring within your institution. So what do we need to do to understand, this is one of our three responsibilities, to understand the extent management has established this risk management program in our credit unions and whether or not it's effective. The question is to ask. You don't have to do it, but as you can see from our slide here, do we have a well-defined process for categorizing our risks that cover, primarily these strategic and operational and reporting risks that we have? We can talk about all the different types of risks that are out there, but we kind of lump them into these three buckets when we're talking about them. Secondly, you have to define risk. Risk means different things to different people, and you should sit around and look at what those things, what everyone thinks is risk and not risk. They see risk here, and I don't see risk there. You have to include not only the threats, but you have to look at opportunities that you have. And, I think what you're looking to do eventually is to come up with a framework that identifies the principal risk factors along each of your business lines, your overall objectives and activities out there with your members. The next question we need to look at is, oops. Oh, not. Okay. Next question. We need to ask, and as we're watching these strategic plans come together, and is risk management truly an integral part of the planning and also day-to-day operations in individual areas? Do we have a comprehensive set of risk management policies? Do we have programs and procedures that provide for appropriate approvals and that they are relevant? So as you can see, we're building internal controls into some of this risk management. Who gets to sign off on that loan is, perhaps the most basic. Can the vice president of lending, what's their approval level versus, a new loan officer that we've just recently hired. I think every part of your organization should, have a business plan. The managers for each area should be putting together business plans for their parts, their areas of the credit union, and where they identify the risks to their operational areas, the risks to their operational areas and how it might affect the strategic plan. And then everyone can incorporate and say, hey, I have adequate resources, I don't have adequate resources to manage what's going on in my area. The next question that we need to ask is, how do we coordinate risk management across the entire organization? I mean, obviously we've said this before, but the planning process should coordinate the risk management process and right down to the line management and different departments in your credit union. Typically, we need to designate an individual who's going to be responsible for coordinating this risk management. I have 2 credit unions now who have hired a full-time risk management officer. And these credit unions are only about $180 million in assets. But this is, the CEO is responsible for so many things. They've hired a risk management officer who goes through and has defined our policies, the risk management, what's to be done, and monitors what's going on in each of the departments. We need to hold not only the CEO, but our managers and our staff responsible for the risks related to their day-to-day activities. We have to hold management and accountable, and that means also not just the CEO, but those down the line need to know that they are responsible. And this is perhaps the most important factor in my mind in building a risk-aware culture. And of course, though, it is the responsibility of the CEO to make sure no major risks are overlooked. So as you are, in your assessments of the credit union's performance and those types of things, that's, it really comes down to that's your CEO and who, is going to be responsible for this program. What do we need to do, Bob? You talked about reviewing our portfolio of risk and compare it against the credit union's appetite for risk. And what should we be looking at and asking in regards to these? First is, how do we ensure the credit union is performing according to business plan and within those appropriate risk tolerances? So I have a lot of people who might be making budget, but that's not really the business plan. They, are within budget, but they're taking entirely too much risk to meet that budget. So we need to do a few things. One, we have to make sure that we have the appropriate systems in place to ensure that you can achieve these business objectives without taking undue risks. I said before, the monthly board minutes, I think you should contain these key performance targets, any related risk factors as to where you are. I have credit unions who just every month give, on the ALM side, give their credit union boards, and in the minutes there's a little dashboard on the ALM standings of the credit union, credit risk information, those types of things. And obviously throughout the credit union, not just the board, but your managers and employees should be aware of the performance of the credit union, what these, the planned actions of the credit union are, and if we're not living up to performance, hey, why? And then what are we going to do to correct and get ourselves on track? The next thing is, how do we monitor and evaluate changes in the external environment and the impact on the credit union strategy and risk management? We have to make sure, and this goes back to part of the overall planning process we probably all go through, but we need to monitor our economic environment. Obviously, most boards and almost all my credit unions monitor rate competition out there. Credit unions are more dependent than ever on technology. It's probably the biggest challenge to the small credit unions out there is the rate of change in technology and offering these delivery channels. But we need to stay on top of these things. That doesn't mean we need to be the first adopters, but we want to take a look and know what's kind of coming. New competitors. Remember back in the early 2000s, no one thought much about the ING's, electronic banking, and all of a sudden they're there, and they're a significant presence in these types of things. Are there other competitors who are coming into lines of business that, we've traditionally assisted our members or driven towards our members? It could be financial planning, it could be in investments, different types of lending environments. All the major brokerage houses have mortgage lending programs out there that they're out there and competing with you. Political and regulatory environments, we need the management should be in the board. Everyone should be staying up on what's going on with the regulators, the politicians. I know, CUNA, and there's probably got to be about a dozen different news feeds in the credit union industry alone each day, but people need to look at those things. We need to look at our new markets, what products we might be looking to offer, not today, but down the road, and look to see if those products are appropriate for us. And lastly, and I talked to a couple of my credit unions in the past year, is changes in the membership base. As we only have 2 credit unions that we have what we call closed memberships. That means they have one primary seg. Most of our credit unions are either community-based or there are multiple seg. And when I say multiple seg, they may be, have close to 1,000 segs in their membership base. So monitoring and knowing what's going on in your membership base. Are we aging out? Are we bringing new, younger members in? Those types of things are pretty significant in understanding the risks that may be facing your credit union and its plans. Our next question is, what information about the risks does the board get to help fulfill its stewardship and governance responsibilities? Does the board agenda, are they talking about these things, events, trends, how they impact our plans, or the continued validity of the assumptions? Are we continuing to march down this plan even though we found out our assumptions are not particularly valid? Are we still following that, or are we taking a step back? The board, I think, and committee should get periodic briefings from different operational areas of the credit union, whether it's your human resources, whether it's your finance, your compliance officers, just so that they can talk and bring you up to date on what they see are the emerging risks for your credit union. And obviously, are we prepared? Pretty interesting for a predictable emergency. I was right in the heart of Sandy here on the East Coast, and I will say virtually, I think one of our credit unions, the longest they were down was 48 hours here in Monmouth County. The rest were up and going in about 24 to 36 hours. But there's, and we have, compared to the community banks, there's community banks that still have not reopened branches down in the shore area. They can't get to utilities to reopen those branches, believe it or not. Other things we need to look at is, what happens, with our CEO. What happens if our someone in our key management team is suddenly taken ill or disabled or can no longer work or has a job change? Are we ready for that transition, or do we have a process in place for that transition, especially since the CEO is the person who is most engaged in managing this risk? Things I look at from management and good management questions or procedures are, does management provide the board and perhaps us as the supervisory committee, with prompt briefings? In other words, if there's been a serious matter, an incident that has a significant financial implication or potential to damage the credit union's reputation, say they uncover a significant embezzlement or another serious breach of the code of conduct, do they immediately let us know? I mean, this is good reporting by management, and this is how we look. How do we get information and know that management is monitoring these risks? At each board meeting, or not each, but regularly at board meetings, the boards are asked to approve a specific proposal or action plan, and as we're reviewing those minutes or sitting in those meetings, we need to evaluate, are they getting a balanced picture? Are the risks and opportunities being balanced appropriately? Do they discuss the alternatives that were rejected as well as the proposals being advanced? Again, I had mentioned to you before, you should always take a look at the worst case scenario, so what it, if it all blows up, what it could happen. That doesn't mean. And the fourth one here, I put in because I've sat through enough strategic planning sessions with my clients, and I watch management particularly put together these plans and stuff, and with enough questioning you find out that management perhaps has significant apprehensions and uncertainties about the plans and programs they're to put in place. And I think management should share those, especially if they're giving a well-balanced picture and asking the board to approve. The big question, are we taking the right amount of risk? The capacity to take risk is, related to your financial position. I know there are critics that have said in the, of the industry that the credit industry has too much capital, and that has resulted in excessive risk-taking. I think I think that's too blanket a statement. I have credit unions that have an awful lot of capital, and that's because they take little or no risk. And I have others who, take an appropriate amount of risk, and some that are very aggressive out there. The risks that we do take, is this, related to our values and expectations? Are, what really are our core values, or are we just trying to become the big gorilla on the block versus what we really value is member service, member satisfaction, those types of things. So this planning process does need to take into consideration your capacity, your risk appetite. I call it the warm fuzzies. Can you go to sleep at night and not going to worry about it too much along the way? And are there clearly defined processes for monitoring and communicating and approving the risk tolerances levels? Not just a general set, but a real well-defined process that the board is comfortable with, the supervisory committee is comfortable with, when you head down, when you manage your risk and the risks that are out there. I think it was Warren Buffett who said risk is the result of not knowing what you're doing. And, that's pretty plain as we get into a lot of our newer services. Not everyone is really aware of all the risks that are out there, as we're seeing in some business lending and participations, indirect lending type products. Not everyone is really aware of within our own clients of the risks that they're getting into, and suddenly when things don't perform quite the way that they hope to, everyone starts saying, well, we got to shut this down, as opposed to tweaking it and getting it on track. How do we go about doing this? It seems like there's a lot to do in order to have an enterprise risk management process and strategy in our organization. First, I say to everybody, select the appropriate team. This is more than one person can do, even in a modest-sized credit union. You have to have representation from all areas of the credit union. And start slow. I once had a credit union who received a comment in a document of resolution to have a risk enterprise risk management analysis completed within 30 days for the entire organization. Of course, management didn't know what to do. The examiner didn't even understand what they were asking them to do, but we want this done in 30 days. So I tell everyone, start slow, 1 or 2 areas at a time, and you'll build on that. You get better at it as you do more of them. You have to have a good understanding, this team, of your credit union. The processes, the controls, the compliance, the risks that you face, and you're not starting from scratch. Chances are you're building on things that you may already have. But what you're doing is, the key thing here is documenting that analysis and those controls and those processes. So, you're going to go through and interview the owners, you know, of those processes, whether it's the teller up front, is it your marketing person or human resources individual, and go through their processes, what they see as risks, what they define as risks, and what controls they have in place. And now you can come up with an inventory of risks that you face and how you'll manage it. And then lastly, again, management, and I think especially internal audit gets involved in continuing to always monitor and reporting what our risks are. If we went back to one of those previous slides, you saw the circular arrows there. I mean, you start and it just comes around and goes around, and it's an ongoing process that you're never really done. You know, you're always going back in and rebuilding, remodifying, you know, just making sure that your processes are still intact and are complete. And last, this really brings me to my next slide. You know, you have to take risk is the point of this slide. You know, the only way to have success is to take some risk, some form of risk along the way. But how much risk, you know, is up to those charged with the governance of the credit union. You know, shouldn't be just set by management. Everyone should understand the potential risks and the impact that they may have on your institution. So with that, I would, I guess I should change this back to you, Celeste, if you've got some questions.
You can leave your screen up, that's fine.
Oh, okay.
Yeah, so if anyone has any further questions, I've gotten a couple questions actually just for the general purpose of the webinar. Lauren is going to be emailing all participants who registered for the webinar. She'll be emailing a copy of the slides, of your slides today, Bob, as well as a copy of a CPE form if anyone needs that to apply for CPE credit, and also an evaluation form. And we encourage you to fill that out. That helps us to develop our future webinars. Bob, did you have any closing comments for the group?
Well, you know, as I said, what we're doing and these questions that we're going through, you know, our role as supervisory committee members is an oversight role. It's not, this is not where we should be. Our sleeves don't need to be rolled up, but we should make sure that management and the board sleeves are rolled up and addressing how they manage risk within the credit union.
Great. Well, thanks again, Bob. That was a lot of great information, and I wanted to thank everyone again for participating in today's webinar. We hope you'll make plans to join us for NACUSAC's 2013 Annual Conference, June 12th to the 15th in Savannah, Georgia. If you want more information, please visit our website at www.nacusac.org. In the meantime, if you could please take a moment again to return the webinar evaluation form. We hope you enjoy the rest of your day. You may now disconnect. Thanks, everyone.
Okay. Thank you.